Morning, Brent. How are you today?
Hey, good morning. I'm great. How are you, Jessica?
I'm good, thanks. So, I wanted to talk to you today about if there's any way, with interest rates being what they are, to see if there's a more affordable way to bring down the cost of a loan at this time in the market. So, I've been seeing a lot on Instagram, on Facebook, on even TikTok about 2-1 buy downs. I've been seeing it from
Right.
realtors and also from mortgage lenders. Could you give us the scoop on what a 2-1 buy down is?
Sure. So this was popular back when I started in the business in the mid 90s. 2-1 buy downs, they've probably been around longer than that, but nonetheless, they haven't been popular in the last few years because the interest rates have been so low already. So um, having rates come back up into that range that we had in the 1990s has resulted in, the 2-1 buy down kind of coming back. What it is if we have an interest rate at, say, 6.5% on a 30-year fixed, a 2-1 buy down is going to take the first 2 years of that loan and lower the interest rate. So it'll take, meaning 2% lower to start, and then it will change 1% per year until it's up to its original interest rate at 6.5. So in other words, your first year, you're going to have a 4.5 interest rate. Your second year, you'll have a 5.5 interest rate. In your third year and going onward, it'll be 6.5. The differential in cost or in interest rate, that is collected at closing. So in other words, you're essentially coming out of pocket with the interest up front for a cheaper payment for the first 24 months. But a 2-1 buy down is temporary in nature, and it really is just a push. It doesn't have result in a really doesn't result in a true savings in interest. It just has a lower payment initially that you pay for up front. Make
Okay,
sense?
I think so. So, okay, let's put some numbers to it. So, if we were going to let's look at a $250,000 mortgage for someone, and say they're going to do this 2-1 buy down, and so what kind of savings would they be looking at in year one?
So initially, it's pretty substantial. You'd have a payment. Your regular payment at 6.5 would be principal and interest about $1,580. At 4.5, that same principal and interest is at $1,266. So
Wow.
there's a little over $300 a month savings in that first year each
And
month.
okay, and then there's 12 months in a year, so 300 times 12, that's $3,600 of savings.
Correct.
That's substantial. Okay.
Correct. The second year, it'd be at 5.5. So that second year was going to have a savings of about 160 per month.
Okay.
So over 12 months, that'll have a specific amount. When you take those, about what is it, almost $2,000.
Yeah.
So the savings over the course of those first 2 years is approximately $5,700. That money is collected up front at the time of closing, whether you're paying it as a buyer or the seller is paying as part of the contract negotiation. That is collected at the time of closing.
Okay. Couple of things here. So it's not like that $5,700 is just like evaporated by the bank and they're like, never mind. No one has to pay $5,700.
Right.
Someone
Nope.
is paying $5,700.
Correct. It's collected.
So if
Yep.
it's paid by the buyer, I don't see how that's beneficial if the buyer is paying
It's the
it.
push. Correct. It's a push. They paid the interest in advance, and they get a slightly lower payment for those first 2 years.
But you're out
But they're
5,700 before you even
but they're
start.
still paying they're still paying all the interest. It's not like there's an interest savings here.
Okay. So if you were able to get the seller to pay it, then that $5,700 is still paid and you're not paying it.
Correct. Now, so you can when the seller contributes money, they can contribute toward standard closing costs, taxes, insurance, all of those items that you have when you close. They can also contribute toward the 2-1 buy down. It's 5,700 is 5,700, and it goes into your pocket one way or the other. It's just how do we deploy those funds? I don't know that creating a cheaper payment upfront is necessarily the best use of money. it can create some budgetary issues where you're used to making for a couple of years, you're used to making a much cheaper payment. Um, it just depends on what the buyer really needs here. You could also go for, instead of doing towards costs, temporary buy downs, you could go for a permanent buy down. That's where there's interest savings. A permanent buy down is where we take the interest rate down permanently on the loan. So in other words, let's say for roughly that same cost, 2 points on 250,000 is $5,000, right? So if you seller is contributing that 5,700, you could put that 5,000 toward permanent buy down and take your interest rate from 6.5 to 6 over the long haul. And you would definitely, that saves you. It's not quite as much as $300 a month. It's about $80 a month.
Okay.
But that $80 is permanent, and so you end up saving a ton more interest over the long term.
Okay, so 80 times 12, so that's about 960 for the year. But by the time you've gone, so like by the time you've gone 10 years, now you've saved almost twice the amount as you would have.
Yeah.
Okay.
Well, it's a zero sum game up until about 5 years. That's your break even.
Okay.
On that $5,000. Okay. But you talk about the next 5 years. So you're 10 years in, and you haven't refinanced or anything. You'll have that savings permanently on the loan. So it definitely makes a big difference over time.
Okay, got it. So when you're talking about budgetary and being kind of anxious for a buyer in their budgeting for if they're doing a 2-1 buy down, just to kind of spell it out, if you're budgeting, your monthly payments at roughly about $1,200 for that first year, and then it kicks up, what'd you say it was, about 13 something?
It goes from 1266 to about 1420.
Okay, so you're looking at needing to come up with a substantial amount of money more. And then when you get to year 3, what are you at? What is the buyer at?
1580.
Wow. Okay. So, I mean, unless you're looking at like a serious job improvement or something.
Yeah, really a 2-1 buy down is gimmicky, sort of, if you'll excuse the expression. It's designed to be flashy in an ad. You can get an interest rate 4.5. That's going to be very attractive, right? Everybody's going to call. That's the point.
Yeah.
But it really doesn't give a serious benefit at the end of the day. There's no long-term benefit. It's just a temporary reprieve on your payment that costs a lot of money up front.
What about that one you use the word gimmicky on, but you and I have talked about adjustable rate mortgages before, and there's just still this lasting fear of those being gimmicky in a way, but you find those to be a really tenable solution, right?
Yeah, those have value. So when you talk about business cycles, right now we're in a tightening cycle, meaning that interest rates are going higher. And as that happens, the economy slows. As the economy slows, interest rates tend to come lower. So they'll ebb and flow, going upward in some points and then downward again. So this, generally speaking, we don't expect this to be stratospheric event where rates just keep climbing up into the double digits. While it's all that's possible, it's not probable. That's not what is expected. Expected is, that rates are going to go up a little bit here, and then we may have an economic slowdown that's by design, and rates will come back down with mortgage rates settling in the 5s. Well, if that's the case, and you're looking at this cycle being over just the first few years here, within the next few years, you can do a hybrid ARM, which is an ARM that is it's still an adjustable rate mortgage, but it's fixed for a certain number of years, like a 5-year or a 7-year. These are fixed for the initial 5 or the initial 7 years, and then they become adjustable annually after that. What you're looking at is a savings up front on that interest rate. Now that's truly going to be about a 1% lower than your existing 30-year fixed. And it's that way for those 5 years. You could potentially refinance within the 5 or the 7-year period. And by refinancing, you could go to another adjustable rate mortgage or like the same one that you just had, or go into a fixed rate if fixed rates have come back low enough. If rates don't come down, of course, it could potentially go into its adjusting phase. But you do have a substantial savings in those first several years, and with the typical business cycle, that's going to be long enough to then revamp the loan at another date. So that's really a good way also to get a manageable payment, a lower payment initially.
So with a 5 or a 7, okay, so we've already talked about how that interest on a 2-1 buy down is still collected no matter what, like it's still paying.
Yep.
Now, is that true on an ARM, or does that savings just happens, or where is that money?
Yeah, that savings is just part and parcel to the product, right? So it's automatic. That's just because you get a lower interest rate for the initial period of that loan, and it doesn't cost anything upfront to do that. It's not a temporary type situation. It is that way until it becomes to its adjustable phase, which is anytime after that 5 or 7 years.
So no one is paying the difference, the buyer, the seller.
Correct.
Okay, so
yeah.
Okay, so how do people make their money? Why doesn't everybody do an ARM then? Is it because of the risk, or like?
Well, yeah, I mean, a lot of people are comfortable with them and do them, and reap the benefits of the savings over the fixed rate. Some people are like, nope, you know what? I'm not comfortable doing anything but a fixed rate. So it really is, and I talk to customers about their investment philosophy.
Mm-hmm.
If they're more aggressive in their investments, they're going to be more comfortable with an adjustable rate. Mm-hmm. If they're very conservative and like, hey, I don't put any money in the market, it's all in CDs, it's all in the bank, they're not going to be comfortable with a more aggressive mortgage. It's part and parcel to your investment philosophy.
Okay. So say you get into one, and then year 7 hits and rates are at 12. Let's hope not. But then you could refinance into what kind of a product if rates were at 12?
Well, you could go back into another adjustable loan. You could go to that fixed rate if you wanted. You could also just let the loan adjust. You don't have to refinance it.
Okay. It doesn't jump straight to what the market is?
No, it has caps.
Okay.
Depending on the product, it has caps on what it can do on any given year.
Okay, got it. All right, so let me just see if I can kind of put this into a summary here. So if you have a seller, because I've seen this now on some listing remarks, it's becoming more of a thing I'm noticing out there in the market, that sellers are saying, we will pay 1 percentage point for the buyer. And so say you are coming in as a buyer and you're like, okay, this house, if I buy this house, the seller has already said they're going to pay 1 percentage point. And then as the buyer, I can choose where I can put that.
But in general, yeah, I mean, if it's just toward costs, 1%, that can be applied toward actual closing costs, a permanent buy down, or a temporary buy down.
Okay, great. And you are open to talking to people about their individual situations, and you could help counsel people on what is the best for their.
I think that a temporary buy down is not the strongest move. I don't advocate for it.
Okay.
It's great for advertising and understanding. Yes, that is out there, and you can get lower rates. It's great for starting conversations, right? Just like what we're having.
Right.
But in a nutshell, it's a push. It really isn't a major benefit.
Well, it seems like with the market shifting as it is, there's more out there for buyers to kind of work with the sellers and get some closing costs provided in the form of concessions. And it's good to hear about these other options too. And I'm so grateful you brought some clarity to what a 2-1 buy down is. I really appreciate it. And thanks as usual for your time and your insight.
Yeah, thank you. Appreciate it.